Okay, so back today for a quick market update. This is Kate Stalter from Prosperity Source, and I'll be doing some of these really quick market updates for you. That's the plan, to just keep doing these for a while. So I'll do a little bit of teaching on reading stock market charts. You're looking at a chart of the S&P 500 right here, a daily chart. I'll say more about that in a minute. Now, this is something, reading charts like this, teaching chart action. I used to do this for a living, although that was a long time ago. But chart reading is a great tool for people to understand, and this is a great time to learn a little bit about this. So you understand what's really going on in the market, not just what you read on the interwebs or what you might hear. Because, yeah, I mean, you can probably see it right here. We had a nice orderly climb, and then all of a sudden everything broke down recently. It's better to understand what's really going on than just to rely on some panicked phrases, because knowing how to read a stock chart will help you sort out fact from fiction, panic from reality, or help you understand when it might be time to make some changes in your account. But you have to do it methodically and not willy-nilly. So let's begin with what's happening right now, put it in context. This is the S&P 500, Standard & Poor's 500, the index of the 500 biggest U.S. companies. And yes, I know for some of you this is super duper basic, but a lot of people have never studied markets. A lot of people don't know what the S&P 500 is, and that's fine, because if you've been living your life doing different things in a different career, it's perfectly fine that you don't know this, and that's what I'm here to help you with. So we're going to just stick to the basics today. So I'm going to switch over to a monthly chart here, and this is MarketSmith I'm using. Some of you recognize this. No, I am not going to be teaching CanSlim. More about that at a later date. But you see up here, very recently, up in late February, the market had reached all-time highs, okay? And then obviously on the coronavirus news, and then also some problems in the crude oil market contributed to that. Unfortunately, you do see this big market breakdown. Now, this line down here, this is the price action over here. And again, we're looking at a monthly chart right here. It's a lot smoother than on a daily. There we go. There's the daily chart. But you see, either on a monthly, you can look at it on a weekly over here. Whichever time frame you use, you can see down here the trading volume, and that's very, very important. Everybody focuses on price action. I get that. But the trading volume can be equally telling. So you see this red line that kind of runs through here on a daily chart? That is a 50-day moving average. So the rolling average of what the volume has been like. These are volume bars down here. The trading volume. Who's making the trades? Who's buying? Who's selling? And for the most part, actually for the overwhelmingly most part, trading volume is driven by the big institutional investors. So that's mutual funds, banks, pension funds, insurance companies, entities that buy huge numbers of shares. And if you have a 401k, for example, your funds are some of those major buyers here that are driving the price and volume action. Individual investors cannot really make a dent with their purchases. So that's just something for everybody to keep in mind. So here's today's uptick, and you see that. So what's interesting here is market is right now closing. Let me see here. It's a little bit after, so it's been closed for a few minutes. I'm in the Mountain Time zone right here, so it's a little bit after 2 p.m. Mountain Time as I'm recording this. And thus far, now this could settle out, but thus far you're seeing lower trading volume on this uptick today. Does not necessarily mean that we might not see heavier volume. Sometimes it takes a few minutes for all the data to come in. Although this week, we do have the traders working from home. I don't know if that's going to make a difference here. May or may not, but in any event, you do see that here. Now, what I wanted to talk about is I saw somebody on LinkedIn say something like, let's celebrate the good news. And I'm sorry, that just made me I don't know, kind of laugh a little bit, not in a good way, sort of sarcastic maybe, I don't know. Don't be so fast to celebrate the good news. We've had some huge volatility, and you do see here we had at least an interim market bottom here. Let's see, in the last trading session right here, so that would have been 323. I'm forgetting what day of the week it is. Yeah, so that would have been Monday, and that's today. So yeah, you did see a rally up from the bottom. That could be a potentially good sign. But, we've had huge volatility. The stock market reflects what these institutions, and frankly, algorithms these days too, it reflects what the people and the machines think is going to happen. So the market is a future focused mechanism. Now, even if the driver today was Congress getting close to agreeing on a stimulus package, we all know businesses are closed. People are out of work. I was just reading an article right before I started recording this about newspapers laying off more people. Now, we know that was an industry that was in trouble anyway, but now people whose jobs seem pretty secure up till recently, covering sports, covering cultural events, and so forth, these folks are now out of work. So the effects of this pandemic, the economic effects I'm talking about right now, will be wide-ranging. A lot of hurt, a lot of pain. So there's plenty of chance remaining for more volatility. So in other words, more sharp up or down action. And so I did talk about the trading volume. Now you notice here, on a lot of these days recently, we have had above average volume on both the upside and the downside. What does that reflect? A lot of uncertainty here. See, sharp downturn, sharp upturn, sharp downturn, sharp upturn. And if you come and look at this on a weekly chart over here that I've just clicked on, I mean, it's still heavily volatile right over here. Monthly chart, you can see the very same thing. Now, one thing I wanted to show you is when you're looking at market pullbacks, you want to look at places where it previously got support. So you see these areas right here, like 1810, the level of the S&P 500 back in 2016. You see 2346 back here, back in 2018. So for now, for this month's current pullback, we are looking at a low of 2191. So we broke this support back here from 2018. So back here in 2016, where we had back here, looks like the low was around 1800, 1810. I want to talk about that for a second. I'm hearing a lot of talk about Depression era performance, okay? And yes, we have experienced unusually rapid declines. You see that here. I mean, you see there have been unusually rapid declines in the past. This is 2008. I'm pointing at right here, okay? And the low, and yeah, I've known this for years. Maybe some of you don't. This is a big thing at the time. Low of 666. Just saying, it zoomed up from there 10 years ago. No, 11 years ago. And you see over here this sharp pullback that we had. Now, unbelievably rapid. During the Depression, markets pulled back about 90% over 3 years, between 1929 and 1932. So we are a ways off from seeing something like that. I mean, we're essentially looking at a pullback that has lasted 1, 2, 3, 4, 5 weeks now, not 3 years. So I really want you to keep that on perspective. I prefer to focus on what's happening today and look at these more recent historic lows. And since we already broke this support back here from 2018, I do think it's instructive to look here at 2016 and what's going on. Now, what was happening back here? You had some declines in crude oil prices. We're also seeing that today. Some uncertainty about the Brexit situation. But I'm monitoring these levels right here, this 1800 kind of level for the S&P 500. Because at some point what happens is these big institutions do come in and say, okay, we do believe, based on what we're seeing, based on what's happening in the private sector, in governments, in this case, what's happening with the situation with the COVID-19, so many things to look at. Yes, crude oil prices will have an effect on this as well. At some point, they're going to come in and say, okay, we believe that now makes sense to start scooping up some shares at bargain prices. I mean, if you recall back in, let me go back to a monthly chart, back in 2008, beginning of 2009, things were very, very bleak right here. Things did turn around. And you do see right here, there were pullbacks along the way. I remember this one right here, the summer of 2011. That was on a possible S&P, not possible, there was an S&P downgrade of U.S. debt that scared people. Things come back again. I mean, this does show you. We've had bad events throughout U.S. history, throughout world history, I should say. And there are mechanisms by which the buyers do come back in. Now, for now, I would not be surprised to see a pullback down to this level right here. And again, since we've already broken this support right here, I would hold off if you're seeing people making buy recommendations. I'm going to go back to a daily chart, making buy recommendations and telling you, hey, the market's low. Now's the time to jump in and start buying things because they're cheap. I read an article today. One hedge fund manager said he thinks it's okay to start nibbling. You know, maybe taking very, very small positions, knowing full well that you could see further declines. I'm never one to call an exact market top or bottom. I mean, that's not a science. Nobody can really do it accurately, and I'm not going to try to do that here. But for goodness sake, if you do decide to dip your toe in, buy a few positions of some single stocks right now, or even some ETFs, do not bet your retirement on this, okay? Do not bet your retirement on any of those trades that are not part of a financial plan that shows you what kind of income to expect over time from your investments. Any gains you see in a single stock that you decide to purchase on a whim, that's fun money. That's not to create a retirement plan around. And it's like anything else when you say, you hear it about money when you go to Vegas. Don't put any money down on the roulette wheel that you can't afford to lose. And I would say the exact same thing about investing in single stocks anytime, not just now. I'm not going to focus on specific stocks or investments right now. I just wanted to show you really the most well-known index in the U.S., the S&P 500, not the Dow. Please don't listen when somebody keeps quoting the Dow. It's the S&P 500 index of 500 big U.S. stocks. It is not the benchmark, but we'll talk about that on another day too. It just gives you a broad indication of what big U.S. businesses, how their stocks are performing right now. So I just wanted to give you some perspective on this. I will be back tomorrow with another look at what's happening with market leadership, what's holding up better than others, and whether or not that even makes a difference right now. Okay? Thank you for listening. Stay safe out there, everybody.